Preparing for FP&A Analyst at Windstream interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What does FP&A contribute to a telecommunications company like Windstream? FP&A connects operational activity with financial outcomes. At Windstream, I would help forecast broadband revenue, network costs, labor, customer trends, and capital spending, then explain performance against plan. The role is not just reporting variances, it is identifying drivers, challenging assumptions, and supporting decisions about pricing, investment, and productivity. I would aim to provide accurate, timely insight so leaders can allocate resources while protecting cash flow and improving network economics. While answering, focus on budgeting, forecasting, management reporting, operational drivers, cash planning, and how FP&A converts subscriber, network, revenue, and expense data into decisions. Question 2. Walk me through how you would build an annual budget for Windstream. I would begin by reviewing historical actuals, current year performance, contract commitments, and strategic priorities. Then I would build operating assumptions around broadband subscribers, churn, pricing, installation activity, labor, vendor costs, and network investment. I would partner with business owners to validate those assumptions, consolidate departmental submissions, and run downside and upside scenarios. After resolving inconsistencies, I would present the budget with clear drivers, risks, and sensitivity analysis for leadership approval. Make sure to cover the planning calendar, historical analysis, operational assumptions, revenue and cost drivers, department collaboration, capital requirements, review cycles, scenario analysis, and final management approval. Question 3. How would you forecast broadband revenue? I would forecast broadband revenue using a driver-based model rather than applying a simple growth rate. The core schedule would roll forward beginning subscribers, gross additions, disconnects, churn, and ending subscribers. I would then apply expected average revenue per user, considering price increases, promotions, speed tier mix, and timing. I would reconcile the output to historical billing results and the general ledger, investigate unusual movements, and update assumptions as actual subscriber trends emerge. In your answer, talk about subscriber counts, gross adds, churn, average revenue per user, product mix, promotional activity, billing timing, historical trends, and reconciliation to the general ledger. Question 4. Which operating metrics would you monitor in a broadband business? I would monitor ending subscribers, gross adds, churn, net adds, ARPU, product mix, serviceable homes, penetration, installation backlog, repair volumes, and network uptime. These metrics explain financial results more effectively than revenue alone. For example, revenue growth with rising churn may be less sustainable, while stronger penetration can improve network returns. I would track both monthly trends and variances to plan, then connect operational movements to revenue, cost, customer experience, and cash flow. Be sure to mention subscriber growth, churn, net adds, ARPU, penetration, serviceability, take rate, uptime, repair activity, installation productivity, and their connection to revenue and customer economics. Question 5. Explain how you would analyze a monthly actual versus budget variance. I would first quantify the variance and compare it with materiality thresholds in prior periods. Next, I would separate volume, price, mix, timing, foreign or accounting effects where relevant, and one-time items. For example, a labor overspend might reflect overtime from installation demand rather than poor cost control. I would validate the explanation with the operating owner, determine whether it is recurring, update the forecast if necessary, and communicate both the cause and recommended action. Focus on quantifying the variance, separating price, volume, mix, timing, and one-time effects, validating with stakeholders, identifying root causes, and translating findings into forecast updates or corrective action. Question 6. What is the difference between a budget, forecast, and long-range plan? A budget is the approved financial target for a defined period and establishes accountability. A forecast is the best current estimate of what will happen, incorporating actual results and changed assumptions throughout the year. A long-range plan looks several years ahead and connects financial expectations with strategic choices such as network expansion, technology, and debt or capital needs. I would use the budget to measure performance, the forecast to manage proactively, and the long-range plan to evaluate direction. Make sure to distinguish the fixed annual target, rolling expectation, and strategic multi-year outlook, while explaining their purposes, update frequency, level of detail, and relationship in management decision-making. Question 7. How would you create a rolling forecast? I would establish a consistent monthly process that replaces the oldest forecast period with a new future period. After loading actuals, I would refresh subscriber, pricing, labor, vendor, CapEx, and other operating drivers, then review variances and management changes. Each assumption would have an owner and documented rationale. I would maintain a base case plus key sensitivities, such as higher churn or delayed investment, so leadership sees both the expected outcome and potential risks. In your answer, discuss monthly actual updates, extending the forecast horizon, driver-based assumptions, ownership, version control, scenario analysis, and preserving an audit trail for changes. Question 8. How do capital expenditures differ from operating expenses, and how would you forecast them? Capital expenditures create or improve assets and are generally capitalized, while operating expenses support ongoing operations and are recognized in the period incurred. For Windstream, I would forecast CapEx by project, separating maintenance, growth, fiber, customer installations, and technology investments. I would incorporate project milestones, vendor commitments, approval status, and cash timing, then link completed projects to depreciation schedules. That approach prevents confusing accounting expense with cash investment and improves both earnings and liquidity forecasting. Focus on capitalization criteria, recurring operating costs, project schedules, asset lives, depreciation, cash timing, approvals, and distinguishing growth, maintenance, and technology-related investment. Question 9. How would you forecast cash flow for Windstream? I would start with operating earnings or EBITDA, then convert to cash by considering working capital movements, taxes, interest, restructuring payments, and other non-operating items. I would forecast CapEx from the project pipeline and expected payment timing rather than simply using depreciation. I would also incorporate financing obligations and minimum liquidity requirements, reconcile beginning to ending cash, and compare actual cash conversion with forecast. Clear timing assumptions are essential because profitable operations do not guarantee near-term liquidity. Be sure to cover EBITDA or operating cash generation, working capital, capital expenditures, restructuring or other unusual payments, financing items, timing assumptions, and reconciliation to cash balances. Question 10. What working capital drivers matter most in a telecom business? Key drivers include customer billing and collections, accounts receivable aging, bad debt assumptions, vendor payment terms, accrued network and labor costs, inventory, and installation activity. I would examine days sales outstanding, payment timing, aging trends, and changes in disputed balances. On payables, I would distinguish sustainable timing improvements from temporary delays. I would also connect working capital to operational events, because higher installations or network projects can increase inventory, payables, and customer receivables simultaneously. Discuss accounts receivable, collections, customer billing, bad debt, accounts payable, vendor terms, accrued expenses, inventory, installation activity, and how operational changes influence cash conversion. Question 11. How would you build a headcount and labor cost forecast? I would build a monthly headcount bridge by department, starting with current employees and adding planned hires, attrition, vacancies, transfers, and open requisitions. I would apply salary increases, bonuses, payroll taxes, benefits, overtime, and contractor costs using appropriate timing. For field operations, I would connect staffing to installation and repair volumes rather than relying only on historical averages. I would review the model with HR and department leaders, then explain both headcount changes and cost per employee. Make sure to cover beginning headcount, hires, attrition, vacancies, salary increases, bonuses, benefits, overtime, contractors, department ownership, and productivity assumptions. Question 12. Tell me about a time you improved a financial reporting or forecasting process. In a prior role, a weekly forecast relied on manually combining several spreadsheets, which created version control problems and consumed hours. I standardized the input template, added validation checks, assigned ownership by cost center, and built a consolidated reporting file with consistent definitions. The process reduced preparation time by roughly 40% and made variances easier to investigate. I also documented the workflow and trained users, so the improvement was sustainable rather than dependent on one analyst. In your answer, use a clear situation action result structure, quantify time or accuracy improvements, describe controls introduced, and explain how you obtained stakeholder adoption. Question 13. How do you ensure data accuracy when using Excel and multiple systems? I begin by confirming the source, period, population, and accounting basis for each dataset. I reconcile totals to the general ledger or approved operational reports, use controlled inputs and consistent account mappings, and include checks for missing values, duplicates, and unexpected movements. I protect formulas, maintain version control, and document assumptions. Before distribution, I perform reasonableness tests against prior periods and operational metrics, then ask an appropriate reviewer to challenge key outputs. Focus on source system reconciliation, controlled inputs, formula checks, consistent mappings, reasonableness testing, version control, documented assumptions, and review procedures before distributing results. Question 14. How would you explain a complex variance to a non-finance executive? I would lead with the conclusion, quantify the impact, and explain the 2 or 3 drivers that matter most. For example, I might say that costs exceeded plan by $500,000, primarily because storm-related repairs increased contractor usage, while routine staffing remained on budget. I would distinguish temporary from recurring effects, identify what management can control, and state the forecast implication. A concise bridge or chart can reinforce the message without overwhelming the executive with detail. Be sure to mention leading with the conclusion, using plain language, quantifying impact, separating controllable and uncontrollable factors, identifying actions, and avoiding unnecessary accounting terminology. Question 15. What would you do if an operating manager challenged your forecast assumptions? I would first understand the manager's concern and confirm that we are using the same definitions, period, and data. I would compare the assumption with historical performance, current trends, contracts, and operational capacity, then run an alternative case if the evidence supports it. I would document both views and explain the sensitivity to leadership rather than forcing false precision. The objective is not to win an argument, it is to produce a credible forecast and surface the risk clearly. Discuss listening first, clarifying definitions, reviewing evidence, testing alternative assumptions, maintaining transparency, escalating unresolved issues appropriately, and preserving an objective, decision-useful forecast. Question 16. How would you evaluate whether a broadband expansion project is financially attractive? I would model the project's incremental homes passed, expected take rate, subscriber ramp, ARPU, churn, installation costs, maintenance expense, and corporate support costs. Against those benefits, I would forecast construction capex, timing, taxes, and working capital effects. I would evaluate contribution margin, free cash flow, NPV, IRR, and payback, then stress test penetration, pricing, delays, and cost overruns. The recommendation should balance financial returns with strategic coverage, customer demand, and network priorities. Focus on incremental subscribers, penetration, ARPU, construction and operating costs, capex timing, contribution margin, free cash flow, NPV, IRR, payback, and downside sensitivities. Question 17. How would you distinguish a recurring trend from a one-time variance? I would not classify an item based on 1 month alone. I would review prior periods, seasonality, transaction details, operational evidence, and whether a similar event is likely to repeat. For example, a storm repair charge may be unusual, but consistently rising contractor costs could indicate a structural labor or productivity issue. I would confirm the accounting treatment with controllership, quantify the run rate effect, and reflect recurring economics in the forecast while separately identifying genuine one-time items. In your answer, analyze multiple periods, operational evidence, management explanations, accounting treatment, seasonality, recurrence likelihood, and whether the item should affect the run rate forecast. Question 18. What Excel tools and techniques would you use in an FP&A role? I use pivot tables and Power Query for efficient data preparation, SUMIFs and XLOOKUP for controlled analysis, and structured schedules for driver-based forecasting. I include scenario toggles, validation checks, variance bridges, and clear input, calculation, and output sections. For larger datasets, I prefer repeatable queries over manual copying. I also keep formulas transparent and document assumptions, because an FP&A model should be easy to review, update, and hand over without losing control. Mention pivot tables, SUMIFs, XLOOKUP or index match, scenario controls, charts, Power Query, data validation, error checks, and designing transparent models that other users can maintain. Question 19. How would you prioritize competing requests from senior stakeholders? I would clarify the decision each request supports, its deadline, materiality, and consequences of delay. Liquidity, regulatory, customer impacting, and executive decisions would generally receive priority over lower impact analysis. I would communicate my queue, confirm the minimum useful output, and provide an interim view when a complete analysis is not immediately possible. I would never sacrifice basic accuracy checks, but I would tailor the level of detail to the decision and follow up with refinement. Focus on decision deadlines, financial materiality, liquidity or risk implications, data availability, strategic importance, communication of trade-offs, and maintaining accuracy under time pressure. Question 20. Why do you want to join Windstream as an FP&A analyst? Windstream interests me because broadband infrastructure combines recurring revenue, operational complexity, and significant investment decisions. An FP&A analyst can make a visible impact by connecting subscribers, network performance, labor, CapEx, and cash flow to management actions. My strengths are building reliable analyses, questioning assumptions constructively, and communicating clearly with non-finance partners. I would bring a disciplined, collaborative approach and develop deeper telecom expertise while helping leaders improve performance and allocate resources effectively. Be sure to connect your analytical strengths to broadband infrastructure, operational improvement, cash discipline, business transformation, collaboration, and the opportunity to support decisions with measurable financial impact. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.